Hello everyone, I am Kunj Kothari from Chirag and Shah Associates, and today I am going to talk about Introduction to IND AS. So let's start with introduction. First of all, we need to understand why there was a need for IND AS to be introduced. So the normal AS that had been used earlier was not completely aligned to IFRS, International Financial Reporting Standards, and IND AS is majorly aligned to all the reporting standards that are met by IFRS. So basically, IND AS converges with IFRS, which thereby improves the comparability of the financial statements, also enhances the transparency and reliability of the financial statements of Indian companies. So there are many pros of IND AS. The first of all is global comparability. Major IND AS standards and IFRS standards stand on the same lines, where it becomes very easy to understand and compare the financial statements of an international company as well as an Indian company. The next is cross-border transactions. There are certain transactions that place in foreign currency, and IND AS provides the guidelines how we are supposed to report on every one of them, which are compared to the IFRS standards. The next is investor confidence. In order to boost investor confidence, IND AS has made the financial statements very much easy for every investor to understand and analyze. And based on the easier financial reporting that IND AS has done, it is easy to make decisions even for stakeholders, banks, investors, and credit rating agencies. So next we will understand what is the applicability of IND AS. So IND AS first became applicable from 2015-16. So all the entities except for bank, insurance companies and NBFCs could voluntarily apply to use IND AS from 2015 or year 2016. But moving forward a year from 2016 and 2017, IND AS was mandated for all the listed entities or entities who are in the process of listing in India who has a net worth which is greater than 500 crores, and all the unlisted entities with net worth that is greater than 500 crores. In the next year 2017 and 18, it was mandated for all the listed entities and entities who are in the process of getting listed irrespective of their net worth, and for all the unlisted entities with a net worth which is greater than 250 crores. So first of all, we like to understand what net worth is. So as per IND AS, net worth is described as equity share capital plus reserves, except for revaluation reserves, less fictitious assets. So there are also certain key points that we should keep in mind in order to check if IND AS is applicable to a company or not. The first key point is limits that are given here in the earlier slides, which were 500 and 250 crores, are applicable based on standalone net worth and not consolidated financial statements. So every company's net worth will be checked on the standalone basis, and not on a consolidated basis. The next is IND AS. If IND AS is opted once, all the upcoming financial statements should be presented as per IND AS, and there is no option of going back to AS. So, and another major point, if IND AS becomes applicable to an entity in the group, then it will become applicable to all the entities that are directly linked to the entities in the group, that is subsidiaries, associates, joint ventures, parents, and etc. So I've also covered a case study which will come further in the presentation based on these lines. Another point is companies that are not covered under the above mentioned roadmap will continue as per AS, and companies like bank and insurance company should be regulated and reported as per the acts that they are governed under. IND AS is also applicable to a charitable organization. So next comes the point of NBFC. So for all the entities except for NBFCs, bank and insurance companies, IND AS began from 2015 and 2016. But for NBFCs, further guidelines were provided from 2018 and 19. So in the year 2018-19, listed as well as unlisted entities having net worth which is greater than 500 crores have to abide by the rules and guidelines provided by IND AS. And from the next year, that is 2019 and 2020, all the listed entities that are NBFCs have to prepare their financial statements as per IND AS, irrespective of their net worth. And unlisted entities having net worth which is greater than 250 crores, how to prepare their financial statements as per Ind AS. So let's move on to the case studies. So this is the first case. Following is the balance sheet of company A listed as on which is listed as on 31st March 2014. As you can see, there are certain reserves that are provided: equity, share capital, liabilities, assets, and miscellaneous expenditure. So in this case, we are supposed to determine from which phase does the company A fall under Ind AS. So as per the given case study, the net worth of company A would be calculated as follows. Equity share capital of 160 will be added. Securities premium of 200 will be added. General reserve of 160 will be added, and fictitious assets, that is miscellaneous expenses, is to be reduced. Keep in mind, revaluation reserve that was earlier given in the question, as mentioned here, should not be taken into consideration while calculating the net worth of a company. Since the net worth of the company surpasses the limits of 500 crores, Ind AS is applicable to it from the phase 1 itself. Phase 1, that is 2016-17. If the company A was if company A was unlisted, still Ind AS would be applicable, since in phase 1, 500 crore limit is for both listed as well as unlisted company. So let's move on to understand case 2. Under case 2, company A, which is the parent company, has two subsidiary companies under it. One is company B and company C. Company B has a subsidiary company, company D, and an associate company E. Company C has a subsidiary company F. All of these entities are unlisted. Company B has a net worth of 300 crores, and all other entities have a net worth of less than 250 crores. So we are supposed to determine to which all companies is Ind AS applicable. So let's move on. So since the turnover under phase 1 for unlisted companies as well as listed companies was 500 crores, Ind AS is not applicable in phase 1. But since in phase 2 the limit for unlisted companies was reduced to 250 crores, Ind AS becomes applicable to company B. And covering the point that we had understood earlier regarding the group companies, since company A, company D, and company E are directly linked to company B, the financial statements of all these companies are supposed to be prepared as per Ind AS. So company A, which is the parent company, company D, which is the subsidiary, and company E, which is the associate company of company B, have to follow Ind AS guidelines. And for company C is not directly linked to company B and is indirectly linked to company B via company A. Hence, it is not supposed to abide by the rules provided by Ind AS and financial statements. And also, company F is not supposed to prepare its financial statements as per Ind AS. However, for consolidated financial statements, since company A is supposed to prepare its financial statements as per Ind AS, the company C and company F will also have to restate their financial statements as per Ind AS in order to consolidate the financial statements. So thank you for the presentation. This is Kunj Kothari, Article Assistant at Chirag & Shah Associates, signing off.